Hello, friends, and welcome to Derivatives. My name is Dr. BJ Tolia, and we are going to start out with the basics of different derivative instruments and their uses first. So, the focus for the exam is understand the different types of derivatives, and there are some that are called as forward commitments, which are futures, forwards, and swaps, and the other ones are contingent considerations, and there are options and credit derivatives. Now, be able to compare over the counter or OTC derivatives versus those that are exchange traded. And we'll talk about pros and cons of derivatives, meaning what are the risks involved and what are the benefits of using derivatives. And then finally, what are the issues, what are the uses of derivative products for issuers, companies, or investors. All right. So derivative is simply a security that derives its value. So the label derivative simply is based on the fact that it derives its value from an underlying. Underlying can be a variety of things. So you can have different securities such as equities or bonds or equity indices, as well as rates, interest rates. And then it can also derive its value based on commodities as well as credit and credit indices. So the underlying can be a variety of different types, and obviously the derivative that derives its value from those types differs based on the fluctuation in the value of the underlying. Now, forward commitment, again, the label here is commitment. Okay, and both parties to that contract are committed to executing the contract. Contingent claims only come into play if certain contingency or condition is satisfied. So, forwards, futures, and swaps are commitments, are forward commitments, whereby we enter into the contract today, but the obligation to complete the contract occurs at some future point in time. Options and credit derivatives are contingent. Why? Because the one party's obligation depends on occurrence of an event, on a condition. So it depends on an event. In the case of credit derivatives, where there is a credit event occurring, so typically that event is called as a default. When default occurs, that's when the satisfaction of that underlying instrument, the satisfaction of that derivative comes into play. In the case of an option, the holder of the option, the long party, the buyer, so the long is the same as buyer. So the long party or the buyer has a right to exercise the option, and that right is going to be exercised only if it is beneficial to the buyer. When you have a right but no obligation, you're always going to exercise your option only when it is beneficial to you. In the case of a call option, it is in the money when the stock price exceeds the exercise price. For a put option, it occurs when the stock price is less than the exercise price. We'll talk a lot more about call options and put options in a little bit. All right, so let's talk about derivative contracts. They can be exchange traded or over the counter. So exchange traded contracts are standardized. They're traded on an exchange and they are standardized. So it basically allows the exchange to list that contract, and because it is standardized, it can trade under a standardized contract. So under a uniform contract. Now, in case of exchange traded derivatives, there is a central clearing, meaning the exchange takes the opposite side of all trades. The exchange mandates deposit of a collateral, and that ensures that the parties that are entering into the contract conform to the contract, adhere to the contract, and these contracts are marked to market, which ensures again that the parties are not deviating too far from and the exchange is able to manage the risk of the counterparty not conforming to the contract, not adhering to the contract. So the clearinghouse basically takes opposite side of every trade. We'll talk about novation, that is a label used when the clearinghouse takes opposite side of every trade. So typically there is a contract involves a buyer and a seller. Well, that contract is broken up and the buyer will then trade with the central clearing, and seller will similarly enter into a separate contract. So a single contract is broken up into two separate contracts, and so the clearinghouse becomes the risk taker to ensure that both the buyer and the seller conform to the terms of the contract. It ensures that the parties to the contract are not concerned about counterparty credit risk. You're not concerned about your other party reneging on the contract. It provides more transparency. Why? Because all the trades are reported. So it is part of the information history. It is more liquid. Exchange traded contracts are very liquid. So you can easily take an offsetting trade if you want to. And typically exchange traded contracts have lower costs. Now, OTC or over-the-counter contracts are basically custom contracts, just two parties agreeing to a contract. So they are very customizable. They are less liquid because if you want to, for example, you take a long position on a trade and you want to back out of that trade at some future point in time, it is difficult to find a party that takes your position, and then the other counterparty has to agree to substitute your position with somebody else. They need to check the credit quality of the substitute party as well. So because these transactions don't occur on an exchange, there is less reporting, there is less transparency, and the trading costs are higher. There is the information seeking costs are higher to find the appropriate counterparty. Now, many OTC markets are required to have a central clearing party. Why? Because it reduces the systemic risk in the market. You have all these over-the-counter contracts which are not reported, and the market-wide risks that entail may be too high in the event of a major fluctuation in the market price of the underlying, and could cause markets to melt down. So to manage the overall integrity of capital markets in a country, governments are requiring many OTC markets to move to CCP or have a central clearing party that mandates deposits of collateral and so forth. It reduces counterparty risk. Now, let's look at a quick example from the Institute curriculum books. Which of the following is a significant difference between exchange-traded derivative and over-the-counter? Choice A says ETDs create counterparty risk, which is not true. In fact, ETDs reduce or eliminate counterparty credit risk. So choice A is incorrect. Choice B says exchange-traded contracts or exchange-traded derivatives are standardized contract. Yes, they are standardized contract, while OTC derivatives are customized. So B is our most likely answer. Let's look at the last choice before we finalize. Choice C says ETDs have higher transaction costs. Actually, they have lower transaction costs as compared to OTC derivatives. So once again, we can now be comfortable choosing B as the correct answer. Another example, if a corporate issuer or a company enters into a centrally cleared OTC derivative contract, which of the following risks is likely of most concern to the issuer as well as to other participants in this market? So you are not concerned with counterparty credit risk because you are using centrally cleared. So you have a CCP taking the other side, managing the counterparty credit risk. Also, interest rate risk can be managed using a variety of derivative contracts. We'll see that when we talk about different types of derivatives. However, the concern remains is that of a systemic risk, meaning the CCP is unable to manage the risks it is taking with respect to diverse parties in that OTC platform. So systemic risk is the one that still remains even when it is centrally cleared, and that risk need to be managed by the CCP. All right, let's talk about forward commitment and contingent claim features as well as different instruments. So first, let's talk about a forward contract. Forward contract is simply a contract whereby we agree on today on a price to deliver specific quantity of security or commodity, and the settlement occurs at some point in the future. Settlement means it is at some future date that the actual transaction occurs. So the price agreed, but the transaction does not occur at the same time. If it is a price and transaction occurring at the same time, then it is called a spot market transaction. But if it is deferred, then it is called a forward contract. So what you're given here is the investor is Procam Investments. They enter into a cash settled forward contract. You are given that the contract calls for 100 ounces of gold, and the buyer here is Procam Investment. And in the case of a forward contract, or in the case of derivatives, you use the term long as opposed to buyer and seller, generally speaking. So the long party is Procam Investments, and the forward price is locked in at 1792.13. Now we don't care what happens to the price of gold in 3 months' time. You are committed to buying it at 1792.13. Now this is a cash settled forward contract. In other words, the actual physical delivery of gold does not occur. Instead, at the settlement date, which is 3 months from now, the difference in the spot price of gold on that day and the agreed upon forward price of 1792 is then exchanged. If the price increases, if the spot price is higher, then the buyer or the long party benefits. If the spot price is lower than 1792.13, well, the long party loses. Why? They agreed to buy at 1792. If the price is cheaper in the market, they are forced to buy at 1792. So today's spot price is irrelevant. We don't even care. At maturity, the spot price is 1780.5. Now this is the price we are going to compare vis-a-vis our forward price. Obviously, in this case, the spot price is lower than the previously agreed forward price, so the long party loses. The difference between the two is the loss that the long party suffers. So Procam is currently long at 1792. They are going to have a loss of $11.63 because the price dropped. The spot price on the in the future turned out to be lower than the previously agreed forward price, and so you have 11.63 per ounce multiplied by 100 ounces, and so $1,163 is what Procam Investment has to pay. So Procam pays $1,163, which is 1163 multiplied by 100. And that will be the loss that Procam suffers on account of this forward position that they entered into. All right, so let's look at another example. We are given mix and match forward contract purchaser. Well, forward contract purchaser, or the long party, is seeking to benefit if the spot price exceeds the forward price. So choice A is matched against number 3. Now forward contract seller, on the other side, is betting on the price decreasing, and so it seeks to benefit from underlying price degradation or depreciation. Neither a forward contract purchaser or seller realizes a gain if the initial spot price exceeds the forward price. The initial spot price is not relevant. We need what? The spot price on the settlement date. So neither forward party or seller realizes a gain if the spot price exceeds the forward price. All right. So that is a discussion about a forward contract. A futures contract is simply a standardized forward contract. So it's basically same thing as a forward contract, except that it is standardized. And why is it standardized? Because it is exchange traded. So futures contracts are standardized forward contracts, and they have standardization with respect to the quality and quantity of good that is covered by the contract, what is the delivery time, delivery date, the place of delivery, and the manner of delivery. Everything is clearly specified. Most contracts are actually cash settled, meaning people, because these contracts are liquid, they trade regularly during the exchange operating hours. And so any change in price can be essentially settled at the end of the trading day. Now, the exchange specifies what is the minimum price fluctuation, what is the tick size, and the daily price limit, meaning the price should not fluctuate beyond those limits. Now, clearinghouse, again, just like all exchange traded contracts, holds the other side of each trade. Margin is posted to manage the credit risk that the clearinghouse takes, and this margin is marked to market daily. So if a party suffers a loss, they need to make additional deposit. If they have a gain, they can withdraw money from their margin account. Margin is considered to be a collateral, not a loan to the exchange. And the long party is the buyer, short party is the seller in that underlying futures contract. All right, so comparison of forward versus futures. Forwards are OTC market, over the counter. They are customized instruments. They are between two willing parties and they agree on the terms of the contract. Because they are customized, they can involve a variety of specifics underlying that contract. There is default risk consideration, meaning counterparty risk. And there is an asterisk there to indicate unless there is central clearing. So if it is central clearing, then that becomes the default risk or counterparty risk becomes no concern to the participants, because the counterparty risk is managed by CCP, the central clearing party. No margin is posted, again, unless there is central clearing, and less regulation of foreign market, because again they are customized instruments. In a futures contract, they are exchange traded. They come within the purview of the security regulators. They are standardized. The counterparty is the clearing house. Margin is required to manage the counterparty risk taken by the clearing house. So let's talk about the concept of novation. We mentioned it briefly earlier. Novation is basically where the clearinghouse or the CCP takes the other side of the trade. So in our previous example, there was a long party, Procam Investments, which had agreed to purchase 100 ounces of gold at a locked-in forward price of $1,792.13 per ounce. Right? The counterparty is the short party, whoever that party is. Okay, now we break this contract up into two parts so that the Procam is now trading with a clearinghouse, and the clearinghouse takes the short position. Simultaneously, the clearinghouse will take the long position with that original counterparty. So you have the original trade now being broken up into two parts. The clearinghouse becomes the common counterparty for both transactions. And the clearinghouse basically manages the counterparty credit risk. And because the clearinghouse is taking that, managing that counterparty credit risk, they will ask for a margin, initial margin. So the contract specifies, the clearinghouse specifies what is the initial margin and what is the maintenance margin. In our example here, as an example, we are saying that the clearinghouse is asking for an initial margin of $4,950 for a contract involving 100 ounces of gold. Both parties will post that initial margin. If the margin falls below 4,500, then there is an additional deposit needed to be made depending on how much it falls below 4,500. So the initial margin is deposited before the trade occurs, before the trade is consummated by the clearinghouse. Marking the market, at the end of the day, any gains are credited to the margin account, any losses are debited to the margin account, and your margin balance is appropriately adjusted. If the adjusted margin balance falls below the maintenance margin requirement, then there is a margin call. So, and that the additional deposit is called as a variation margin. All right, settlement price, which is simply the end of the day value of that futures contract, or the price of that futures contract, and it is simply instead of taking one single trade, it uses average of trades during a pre-specified closing period. Spot price is simply the price of the underlying that occurs that trades in a separate market. So spot market is different than the futures market. Now, keep in mind that the futures price will converge to the spot price over the time of that contract. So at settlement, think of it as the contract is settling at 5 p.m. Well, 1 minute before, the futures price and the spot price should be pretty close. The reason is otherwise somebody will be able to print money by buying in the cheap market and selling in the more expensive market. So there is a price convergence at settlement time, price convergence, because futures market essentially with zero time remaining to delivery becomes the spot market. So now let's look at example of margin and maintaining a margin balance. So original forward price in our example was 1792.13, original futures price. I need to be a little clear or a little precise. So original futures price was 1792. We're going to denote it at day 0. On day 1, the end of day 1, you are given the settlement price is 1797.13. In other words, the price has gone up during the first trading day by $5. So what will end up happening? Well, the long party in our example is ProCam, essentially gets credited the difference between the futures price, the settlement price on day 1, and the original futures price at which they entered the contract. In this case, it is again $5 per ounce. You multiply that by the contract size, which is 100 ounces, so you get $500 is the credit that goes to ProCam's margin account. So the ProCam's margin account now has a balance of $5,450. Counterparty 2, the short party, will experience a loss just as ProCam experienced the gain of $500. The counterparty experiences a loss of $500, and their margin account will be debited by that $500 loss, and which will result in a balance that falls below the maintenance margin of 4,500. So given a maintenance margin of 4,500, you are going to deposit additional $50 known as the variation margin. Okay, so we are going to now look at marking to market example, taking it to multiple days. And so your initial forward price or futures price was 1792.13. We are going to tweak this example where the variation margin is essentially equal to the amount that is necessary to bring it back to the original margin balance of 4,950. So the contract does not say that the variation margin should bring it to the minimum margin level, but rather to the original margin balance of 4,950. So this is a slightly different example. All right, now we already know, based on the previous slide, that the first day there was a gain of $5, and so ProCam's margin account got credited with $500 $5 per ounce times 100 ounces gives you $500. That gets added, and so we get 5,450 as a margin balance. No margin call is being made. Remember, again, the margin, minimum margin is 4,500. If that occurs, if it falls below that 4,500 level, then there will be a margin call, and the variation margin is set to ensure that the margin balance reaches the original margin of 4,950. All right, next day, the price decreases. So there is a loss to ProCam, and that decrease is $10.88 negative 10.88. Again, per ounce, multiply that by 100 ounces, that gives you loss of 1,088. That means that our margin balance now is, after we post the loss, we debit that 1,088 to the margin account. Now my margin balance is 4,360, which is less than 4,500. So there is a variation margin, a margin call. And that variation margin is not 100 and not equal to what is required, 138. Rather, it is 588 to ensure that my margin balance reverts to the original margin of 4,950. All right, so that is my margin call. Now, after the transaction occurs, my margin balance is 4,950. Moving right along, next day again there is a price drop of $4.06 per ounce. Multiply that by 100 ounces means a loss of 406 gets posted, and so I subtract 4,950 minus 406, we get 4,544, and that is now higher than the minimum margin of 4,500, so no margin call is being made. We move on to the next day, and now you have a drop of, again, $4.74, or a loss of 474 for 100 ounces. That is subtracted from my margin account, and we get a value of 4,070, which is less than my minimum margin requirement. So there is a margin call, a variation margin necessary to bring it back to 4,950. So that will be not, after depositing that $880 extra, I'm back to 4,950. The following day, there is actually a gain of $2.05. And so that adds up to 205 for 100 ounces. That gets credited. So 4,950 plus 205 gives you 5,155. Obviously, no margin deposit on a day where we have experienced a gain. And then finally, the last day, the price goes up again $1. So you get $100 credited to your account, and you end up with a margin balance of 5,255 the last day. Now, exam questions are 1.5 minutes, so you don't expect to see 5 days worth of margin computation, but understand the mechanics behind it so that a 1 or 2 day scenario is plausible and you can calculate the margin balance. Now, the next instrument we're going to talk about is swap contract. Swap contract, basically, there is a notional amount, notional or fake loan amount is specified in a swap contract. Now, each party makes either a fixed or a floating interest based on underlying rate, whatever pre-specified interest rate. We typically use what is called as MRR, which used to be called LIBOR before the changes that occur, which phased out LIBOR. So the floating rate is based on MRR, the fixed rate obviously specified in the contract. In addition to interest rate, you can also have swap contract which are based on performance of indices, so stock market index, performance of a bond, performance of a specific portfolio or a commodity. These are OTC or customized contracts, so you can have any readily observable security that determines the payoff on a swap contract. You can have anything that you want to choose, but as long as there is transparency, meaning the underlying is clearly specified so that the two parties don't have to fight over what security to use on the settlement dates. Now, a forward contract had one settlement date. Today is the day we enter into contract, and then settlement date is where the actual delivery or the contract is cash settled. In a swap, there are multiple settlement dates. So swap can be thought of as a series of forward contracts. So again, customized, so you can have you can define how many settlement dates are involved in that contract. Typically, the payments are netted, meaning both parties are not going to, one party making fixed, other party making floating. Doesn't make any sense. The party making fixed sends the full amount and the party making floating payment sends the full amount. Typically, they net it out. There may be a requirement for margin depending on the credit quality of the two counterparties. Again, as I said, swap contract entails multiple settlement dates. So you can have an example where a swap has 10 settlement dates if it is 5-year swap, semi-annual. So every 6 months there is a settlement date. In a 5-year period, there are 10 settlement dates. So again, there are swaps are OTC contract customized, and they are essentially similar to a series of forward contract. A forward contract has one settlement. Swaps have multiple settlements. Now, the most popular swap contract is what is called as a plain vanilla interest rate swap. In a plain vanilla interest rate swap, one party makes payment based that is a fixed rate. The other party makes payment that is floating rate. We will learn about how to determine the fixed rate based on currently observed spot curve of the underlying rate. Again, we are going to use the term MRR for the underlying floating rate. So today's spot curve of MRR will determine what is the fixed rate. We'll see the calculation later on. But right now, let's assume that the fixed rate is 2.25 given to us. You're given that the swap has 5 years and settlement is every 6 months. In other words, 10 total settlements. In this timeline, I've not given you all the settlement dates. There is a break here, but basically think of it as 10 settlement dates. Now, in the MRR world, or previously the LIBOR world, that a year was defined as 360 days and a month is 30 days. This is the 30/360 convention. So for ease of computation, it was determined that we use this 30/360 convention when it came to MRR, or previously LIBOR. All right. So how is the payments going to occur in this plain vanilla interest rate swap? Again, all rates are going to be quoted annual. So whenever you see a rate being quoted, it is always quoted in annual terms. Even though the settlement actually occurs semi-annually, the rate's always quoted annually. Okay, keep in mind. Same thing for MRR. It is quoted in annual terms, even though the underlying is 6-month rate. The floating is 6 months. Why 6 months? Because that is the settlement window or settlement period. So because it is 2.25% per year, we simply take divided by 2, simple algebra there, and we say that 1.125% of the notional is paid by the fixed rate payer. What about the other side? Well, the fixed rate payer will receive the floating rate, and they will basically look at the 6-month MRR. Again, 6-month MRR still quoted in annual terms. You need to divide it by 2. And but that is revealed in arrears, meaning today I know what the 6-month MRR is at time 0. So the first one, let's say it's 3%. The first settlement date will be known at the inception of the swap. The floating rate is known at the inception of the swap, but only the first floating rate is known. The floating rate that occurs 6 months from now, that is unknown, but that will be the rate that is used for the next settlement date. Okay. So here is an example. We are going to do the calculation. So Falcon Investments has entered into a 5-year receive fixed 200 million interest rate swap with a financial intermediary to increase the duration of its fixed income portfolio. Now, a fixed income portfolio duration can be increased by buying longer maturity fixed income securities. So you buy a fixed rate bond that will have a certain duration. If your portfolio already has a certain quantity of fixed rate bonds, you want to increase the duration, you buy more fixed rate bonds, but ensure that their duration is higher than what your current duration is, so that the average will then trend upwards. Or you can also artificially use derivatives, not artificially, you can use synthetically derivatives to increase the duration of a portfolio. To increase the duration, you become a fixed rate receiver. So receiver is used a term as a swap counterparty that receives fixed rate. Payer is the swap counterparty that pays fixed rate. So a receiver position can increase duration, and payer will accordingly reduce duration. Okay, and we will see this again later on as one of the uses of a swap contract in a portfolio example. Okay, now under the terms of the swap, Falcon has agreed to receive fixed rate of 2.25%. Again, remember that is annual. The swap calls for semi-annual settlement, and so you're going to divide it by 2 and pay the 6-month MRR. At onset, the very today's 6-month MRR is 1.95%. Again, remember annual. So you are receiving 2.25. You're paying 1.95 for the first settlement. In other words, you are going to have a net reception, or you're going to receive a net amount of 0.30% or 30 basis points. Remember, that is still an annual term. So you divide it by 2 and you get 0.15% is your net receipt. Well, we are going to calculate in sterling, pound sterling, the amount by applying that 0.15% to the notional, to the 200 million notional provided to us in this example. So that is a shortcut way of calculating the net amount. Let's do it the long way. First, we look at a fixed cash flow receipt. Remember, Falcon is receiver, so they will receive 2.25% divided by 2, because 6-month settlement multiplied by 200 million. And that gives you 2.25 million as your fixed interest receipt. And you have to pay interest based on floating rate, which is given to us as 1.95. Well, don't forget, divide that by 2 as well, and you get 1.95 million as your floating payment. The net amount we already know is 0.15% of 200 million, which is what? 300,000 sterling. So the net receipt to Falcon is 300,000 sterling. On the exam, be careful with the sign. In this case, Falcon is receiving, and therefore the sign is positive as opposed to the negative, which may be one of the answer choices there to confuse you. All right, now let's identify participants in an interest rate swap. So a fixed rate payer. The payer will pay a fixed rate. The first choice says makes payment based on market reference rate. That would be a floating rate payer. All right. May face a positive or a negative mark to market over the life of an interest rate swap contract. Fixed rate payer may face a positive or negative mark to market. You know, if for example, the market reference rate is lower than the fixed rate, then the payer will have a negative mark to market. Well, but that applies to floating rate payer as well. So choice 2 would go with C, and choice B goes with 1. So the fixed rate payer the only remaining choice is 3, receives a net payment where the market reference rate exceeds the fixed rate. Remember, they are paying fixed rate. So if and they're receiving floating, which is the market reference rate. So we mix and matched. Moving on. Again, this is from the CFA Institute curriculum books. We move on to options. So there are two kinds of options, call and put. Remember, a call option gives you a right to purchase a specific underlying, say for example, a stock, at a fixed price. That fixed price is called as the exercise or the strike price. Similarly, a put option gives you a right to sell the underlying at a fixed price. That fixed price is called as the strike or exercise price. Now, the buyer or long party has the option, meaning has the right. And to acquire their right, they pay an option premium upfront to the writer of the option or the seller. So the writer or seller receives the premium upfront, but they are obligated to honor the exercise of the option by the long, should the long exercise it. Obviously, the long is not only going to exercise the option if the option is in the money, if it is advantageous for the long, if the long gains from exercise. All right. Now, option writer again is the seller or short and is obligated to perform if the owner, the long party, exercises. All right. So European options are simply a label used for options that can only be exercised at expiration of the option. American option can be exercised anytime before expiration. Now, obviously, American options has more flexibility, and therefore they are worth at least as much as otherwise identical European options. Oftentimes, they are basically the same. Very rarely you will see scenarios where American options actually trade at a price that is higher than the European options. And there are specific conditions under which it can occur. Right now, let's talk about the profit or loss for a call option. So we're looking at the perspective of the buyer of the option, the long party, and they are paying an option premium of $5 up front. Now, the strike price is set for $40. So once the strike price is, once the underlying price, stock price in this example, once the stock price is above $40, the option will be exercised. The question is, how much above $40 does it need to go for the long party to make money? If it goes to, let's say, $42, yeah, you are making $2 upon exercise, but that $2 is less than the price you paid up front, the $5 premium. Now, this payoff example ignores the time value of money, ignores the fact that you pay a premium up front and your settlement is at option maturity or option expiration. So we are going to ignore the time value for these kind of payoff diagrams. All right. So, So if the stock price ends up below $40, option expires out of money, worthless, $0. Remember, there is no obligation, so you're not going to exercise if it is below $40. Now, at that point in time, your loss is what? The premium you paid, the $5. That's the maximum loss that the long party suffers. The premium goes to nothing. At some point, there is a break even. And what is the break even point? Well, the break even point is the exercise price plus the option premium. So once the stock price goes above that value, in this case $45, that's when the long party starts to make money. And theoretically, the maximum profit is unlimited because the stock price can keep on rising. There is no upside limit to the stock price. For all practical purposes, there will be a limit because option expiration is within a limited time frame. But Theoretically, there is no limit to the upside on a call option. All right. So for an option writer, the short party, the profit figure will be a mirror image. So anytime the long party is losing money, the short party is gaining money. It is a zero-sum game. So if, for example, the stock price falls below $40 at expiration, then what happens? Well, the long party gets zero, short party gets to keep the option premium of $5, and the gain to the short is exactly equal to the loss to the long. Now, for a put option, the expectation for the long party is actually that the price decreases. The buyer, the holder of the option, is betting on the price dropping. And again, we are keeping the exercise price the same as $40, put option price still the same at $5, just an example here. So for the long party, the put option is in the money when the stock price is below the exercise price. But because they pay the option premium upfront, in this case $5, they don't make money until the drop is more than that option premium. In other words, the break even will occur at X minus the premium that you paid, the put option premium. Again, in this case, $40 minus 5 gives you $35 as the break-even point. Now, for a put option, because the stock price cannot go below zero, the maximum gain to the put option occurs when the stock price at maturity or expiration of the option, if it drops to $0. Theoretically, the stock price cannot go below zero. So the worst that could happen to the stock is it becomes worthless, $0, in which case the profit to the option holder, the long party, is simply the exercise price minus ST minus P0. ST is 0, so it becomes exercise price minus the put option value. That is the maximum gain. Or in this example, $35 is the maximum gain possible. What is the maximum loss? For a long party, always the maximum loss is the option premium. For a option writer, the maximum loss accordingly is always the option, maximum gain, is always the option premium. The writer of the option, the only thing they get is the option premium. Potentially, there will be exercise against them. So there is potential higher losses in the future, and that occurs when the stock price falls. Again, their maximum loss is $35, mirror image of the profit function of a long party. A quick question. In a put option seller receives a $5 premium for a put option sold on an underlying with an exercise price of $30. What is the seller's maximum profit under the contract? Well, that is always, for doesn't matter call or a put, the maximum profit is always equal to option premium, in this case P0 or $5. And by the way, this should be P0. All right, so now the second part is, what is the maximum loss under the contract? Remember, the maximum loss is when the stock price goes to zero. They have to pay $30 for a worthless stock. Well, they got $5 up front, so the maximum loss is $25, which is simply the exercise price minus the upfront premium they received. So here is your payoff figures. Again, we are looking at from the perspective of a option writer. So the maximum loss is $25 and the maximum gain is $5. The break even, which you are not asked in this question, but if you were to calculate the break even, it will be simply equal to the exercise price minus minus the option premium. So at $25 stock price, the the option writer is neither in the money nor out of money. They are breaking even. All right, quick question to identify, mix and match here. So put option seller. Put option seller is earns a profit equal to premium if the underlying price at maturity exceeds the exercise price. Remember, put option seller benefits when the stock price does okay or well. So in this case, again, choice 3, earns a profit equal to premium if the option expires worthless, and the option expires worthless if the stock price exceeds the exercise price. Call option seller earns a profit equal to premium if the underlying price at maturity is less. So things don't go well, then the call option seller benefits. So that is choice 2. And then both an option seller and call option, put option and a call option seller has no counterparty credit risk. Why? Well, remember, the seller receives the premium upfront. Now they have obligation but no rights, meaning the only thing that could happen is somebody is going to exercise. They already received the premium, so they're not concerned about the counterparty reneging. The counterparty would be concerned about the option seller making good on their obligation. Let's talk about credit derivatives. Credit derivatives is a type of derivative product that are contingent upon a specific event occurring, typically default. So there are two parties in a credit default swap, a protection buyer and a protection seller. Now the protection buyer is like taking out an insurance policy. So they are taking out an insurance policy on a specific financial instrument, a bond, for example, and they are the underlying credit event is the default of the issuer of that bond. If the issuer defaults, well, the protection seller, the insurance company, will make the protection buyer whole. Now, keep in mind, these are derivative products, and there is it is not necessary for the protection buyer to actually have a vested interest in the reference obligation in the bond. Why? Because they can just be speculating. They could just be saying, oh, the bond I think is going to be downgraded, which case they may choose to be a protection buyer. They are betting on things going bad for that issue. So as a speculator, they are not hedging the underlying risk, even though I use the insurance policy buyer analogy in practice. Yes, CDSs are used for hedging purposes, but are also used for speculative purposes. If the credit quality of the reference obligation degrades, goes down, then the protection buyer will benefit. Remember, even though the underlying pays off only when default occurs, the price of the underlying policy will change as the credit quality changes. So if the credit quality gets worse, the price of the policy will, the credit spread will increase. Well, the protection buyer has already locked in a credit spread, so they can then turn around and sell it in the open market and take the difference in spread and profit from that change in price. Calculations are not necessary for you at level 1, but recognize that the protection buyer is basically betting on credit quality going down if they are a speculator. Now, so CDS is used to hedge or to take on credit risk. Now, these are not a one-time instrument. CDS as a label swap indicates what? Multiple settlement dates. So a lot of CDSs typically have quarterly settlement, in which case every quarter the protection buyer makes the periodic policy premium payment to the protection seller. And remember, this is a swap, so both parties are obligated to conform to the obligation. The protection buyer cannot stop making periodic policy premium payments during the life of the swap. They have to continue. The only time the swap ends is early is if both parties agree to end it early after making the appropriate mark-to-market payment, or there is a default with the credit event occurs, in which case, just like an insurance policy on a life terminates upon the death of the insured, well, same thing. If a credit event occurs, this policy is terminated. Now, at time zero, the protection buyer, based on the credit quality of the insured instrument, the reference obligation, they determine that 100 basis point credit spread is appropriate based on market observed data, and they agree on this 100 basis point as the policy premium to be paid, let's say, quarterly. Now, so the protection buyer pays that 100 basis point premium to the protection seller. Well, if there is a credit migration, and meaning stuff gets worse, you are going to see that the credit spread widening, increasing, becoming bigger. But our locked-in spread is the same, and that is where there is a expectation of both parties conforming to their obligation. There could be credit quality improvement where the spread may shrink. Well, still the protection buyer has to pay the previously agreed upon 100 basis point spread to the insurance company, the protection seller. Now, the gain, because the policy is fixed at 100 basis point, remember I said the protection buyer could turn around and sell it in the market if things had worsened, and let's say the spread has changed to 120 basis points. If things got worse, credit migration means ratings downgrade, for example, and you have 120 basis points as the market credit spread. Well, the difference in the two times the notional times the effective duration of the CDS is basically the gain that the protection buyer will accrue. And then if there is a actual credit event occur, meaning there is a default, then what happens is the payment is equal to loss given default percent times the notional. In other words, your $100 bond goes down to 60, then the loss given default percent is equal to 40. So 40% of the value was destroyed because of the occurrence of the credit event, because of default, and 60% was destroyed, 40% is remaining. 60% is remaining, 40% was destroyed. That's your loss given default. And then so 40% of the notional is paid by the protection seller to the protection buyer. Okay, so mix and match for credit derivatives. You are asked to identify the CDS contract participant, whether it is protection buyer or seller, and what and associated with the appropriate statement. Now, credit protection buyer faces an MTM gain if the spread increases. So you're looking for a higher credit spread, and that is corresponding to statement number 1, seeks to gain from higher issuer credit spread. Remember, exact opposite for the protection seller. They stand to gain when the CDS spread decreases or credit spread of the underlying protected instrument decreases. What about both protection buyer and seller? Well, the only remaining one is they are entering into a derivative contract to transfer the risk of loss from credit event. So the transfer of risk of loss occurs from buyer to the seller, or if the buyer is not holding the underlying itself, then it is simply a speculative instrument. But so there is a transfer of risk for a credit event of an unrelated third-party obligation, meaning a debt instrument issued by a third party. All right, let's talk about the benefit, risks, and uses of derivative contracts. Now, first, the benefit. Benefit is it allows participants in the market for derivative contracts to transfer/manage existing risk. If you want to reduce your risk, you can use derivative contract. You can actually gain exposure if you don't have some specific exposure by taking on derivative contracts. Also, derivatives allow you to easily obtain a short position. So if you take a short position in a futures contract on a specific security, well, you are getting your short position without actually shorting the underlying in the spot market. So it is much easier, more efficient to get short exposure via derivatives as compared to the spot market transactions. The third benefit is lower transaction cost. The cost of because of the contract size and the efficiency in the market, the transaction cost in the derivatives market tends to be lower rather compared to trying to get the same exposure in the spot market or the market for the underlying. Lower cash cost basically allows you to take a lot of leverage. Think of a call option, very small amount to get the exposure to the stock. A very small amount is the premium relative to the price of the underlying stock. Also, higher liquidity. Derivatives market for especially standardized contracts, they tend to have great amount of liquidity. So therefore, again, more efficiency in the market, in the derivatives market. Improve the efficiency of market prices. So we will see that the prices of the derivatives is linked to the price of the underlying. And when that price mismatch occurs, there is an opportunity for an arbitrage profit. When the arbitrageurs enter into the market, they will force the price to be the market prices to change to eventually become arbitrage free, and that therefore improves efficiencies. Also, derivatives provide for what is called as informational discovery, provides more information to the market participants. It can be used to price or estimate volatility that is currently priced by the market in option prices. So one of the factors that goes into the pricing of options is volatility in the price of the underlying. And higher the volatility, higher the option price, both call and put options. So you can use those observed call and put option prices from the market data to estimate volatility expectations that are priced in by the market. It also provides you some estimate of future prices. So for example, if you're looking at prices in the futures market, that is your market's perception of what the prices will be. Or if you're looking at a forward market, again, it provides estimates or prices expected to be in the future. Again, those are estimates. There is no guarantee the prices will fully map out, because as new information gets released to the market, the prices fluctuate, prices change. And then finally, when the underlying contract, when the derivative is dealing with interest rates, again, it provides some guidance, some insight into the market's expectations about changes in rates going forward. Now, let's do again mix and match question. So identify the benefit that correspond to the following statement. So the price discovery. The price discovery basically you are able to use the market data from a derivative market to get some insight into the market's expectation of price going forward. And you look at statement number 3, investors track an equity index futures price to gauge sentiment before the market actually opens. So prior to the opening of the market, you look at the futures price and then get an idea as to the expectations of opening price in the market when the market actually opens. Operational advantages. So one benefit in case of a specific type of derivative futures market, the margin requirements are quite low, and therefore it provides an operational advantage. You can get more exposure for a fixed capital, or you need less capital for getting the same level of exposure in the derivative market as compared to cash market. And then finally, last choice is risk transfer, and that corresponds to statement number 2. The ability to buy or sell derivative today eliminates the timing mismatch between an economic decision and ability to transact. If, for example, I'm expecting to need capital 3 months from now, I'm expecting to take out a loan 3 months from now, then I can enter into a forward contract, an FRA, forward rate agreement, to basically lock in a rate today. So before because there is a mismatch. I know today that I will need that financing, but I don't need it today. It is something that will be needed in the future. I can transfer the risk of uncertainty of future rates by locking in the rate today in the derivative market. All right. What are the risks associated with derivatives? The big thing is transparency, where there are several instruments which may be complex and therefore have risk exposures which are not fully understood by investors. Basis risk is where you're trying to manage a specific risk, but the derivative instrument is not behaving exactly like the underlying. And so there is a mismatch. So if you're trying to manage your fuel cost uncertainty by using oil contracts, well, your fuel cost is not exactly perfectly correlated with oil prices, and so there is a basis risk. Liquidity risk is where the mismatch of derivative cash flows vis-a-vis that of the underlying portfolio. So for example, if you get margin calls, there is a cash flow that needs to be met. Cash needs to be arranged, which may not be the same time that you receive cash from your underlying portfolio. Counterparty credit risk depends on the derivative position. If you are looking at OTC contract, you're concerned about your counterparty defaulting. Finally, last one is systemic risk. Systemic risk arises because of excessive speculation, such that even if it is exchange traded, or even if there is a central counterparty, the margins may be insufficient if there is excessive price movement in the market. So if the prices jump, remember there is a price limit specified for an exchange traded contract, daily price movement limit. But what if that price limit is violated? Well, then the margin may not be sufficient to ensure against default by counterparties. So that is systemic risk, where there is a large shock to the system. So now again, we are going to match risks to statements talking about those risks. Liquidity risk is simply the risk of divergence of cash flow timing. You need to come up with a cash flow to meet your margin calls, for example. Basis risk is the risk that the expected value of derivative differs from that of the underlying. So you are trying to hedge something, and the instrument that you use to hedge may not perform exactly like the underlying that you are trying to hedge. And then finally, the systemic risk, the excessive risk taking in the market, coupled with huge amount of leverage that is typically employed in derivative contracts, contribute to market stress. All right. So uses of derivative contracts by companies, corporate issuers. So a corporate issuer can use derivative contract, for example, to reduce the duration risk of fixed rate debt. So if a corporate issuer has currently issued debentures, bonds carrying a fixed coupon, and they basically are concerned that if the rates decrease, they will not be able to take advantage of the lower financing cost. Well, one way to reduce that risk is to simply enter into a receiver swap, where you are entering into a plain vanilla interest rate swap and you're paying floating. You're receiving fixed, hence we call it receiver swap, and you are paying floating. You've converted your fixed rate liability into a floating rate liability using an overlay of a swap on your existing fixed coupon bond. Airline can reduce the risk for fuel costs by buying futures specifically on jet fuel. International corporations which have investments in foreign subsidiaries, or which have international transactions, maybe they are exporting something to foreign countries and they're receiving foreign currency. Well, they are concerned about those accounts receivable in foreign currency leading to lower value once converted, because that currency depreciates. They can lock in the value of those foreign currency receipts or payments by using foreign exchange or currency forward contracts. So those are three examples of usage of derivative contracts for risk management by corporate issuers or companies. In addition to it, corporations can engage into, can use derivatives for fair value hedging. So instead of hedging a specific cash flow, or here we are talking about hedging the value of a underlying. So if you're long an underlying, meaning it's an asset, say for example, the company has investment in a stock, specific stock, and they're concerned about the value of that investment decreasing. Well, one thing they can do is to simply enter into a short forward position. Short forward allows you to lock in a selling price at future point in time. If the price does drop, well, you have an exit price locked in ahead of time, and you're not going to have that much of a loss. So that is a fair value hedging, locking in a selling price in the future. If you are short an underlying, if it is a liability, if you have a specific liability that is subject to fluctuation in value, well, you can hedge that exposure by going long. So you are basically locking in the price at which you can settle that liability and not be worried about the fluctuations in value of that liability. So hedge accounting is simply recognizing gain or loss in the financial statements for a corporation. For a cash flow hedge, we want to remove the variability of cash flows. Let's look at an example. Again, fixed rate payer swap to reduce uncertainty about existing floating rate debt. So if you have a floating rate note outstanding and you're concerned about the fluctuations in rate leading to fluctuations in your interest cost, interest cash outlays, you can do a swap to convert a floating rate liability to a fixed rate liability. Again, use currency forward to lock in the value of accounts receivable denominated in a foreign currency or accounts payable denominated in a foreign currency. Fair value hedge example is a gold miner, a corporation which mines gold, is concerned about their inventory of gold. Well, they can lock in the value of that inventory by entering into a short position in a forward contract. So selling forward contracts. A floating rate payer, so entering into a swap as a floating rate payer, which is same as a receiver position, receive fixed, and you are concerned about changes in value of a fixed rate bond liability. You're basically, remember when you enter in as a receiver, you are extending the duration of your portfolio, but here your duration is negative because it's a liability. So you are taking a positive duration exposure by entering into a receiver swap and offsetting that negative duration position. Net value hedge. For example, you have a foreign subsidiary, you have made an investment in that subsidiary's equity, you contributed, let's say, US dollars, and the subsidiary is based in Japan, and so their assets and liabilities are in Japanese yen. You are concerned about the value of yen vis-a-vis the US dollar. You can hedge that exposure using currency forward contracts. So now mix and match, matching the different types of hedges to the statements that represent those hedges. So first, the cash flow hedge, and you are using derivative that is absorbing the variability, fluctuation of cash flows from an asset or a liability. So that's your cash flow hedge. Fair value hedge. So again, very obvious, fluctuation in fair value, and that is your choice one. And then finally, net investment hedge, that pertains to a foreign subsidiary, and you're concerned about the value of equity in that subsidiary because of the fact that that is in a foreign currency. So those are your mix and match. Let's talk about the uses of derivative contract for investors. We talked about for corporations. Now let's talk about for investors. Investors can use derivative contract to speculate. They can speculate, for example, on the value or price of silver, by buying it on the forward contract. If the price goes up, the investor gains without actually having to buy the silver in the cash market and storing it in their warehouse. They can decrease the duration of a bond portfolio. So for example, if you have a bond portfolio and you want to increase the duration, why would you want to increase duration? You are expecting rates to go down. Remember, when rates go down, higher the duration, higher the benefit of price appreciation that you experience. So you want to increase the duration, what do? You enter into a receiver swap. And if you want to decrease the duration, you enter into a payer swap. So buying is receiver position, selling is a payer position. Examples of altering a risk of an equity portfolio. You buy index forward to simply increase the risk exposure. You don't have exposure to equity. You don't want to sell your bonds in your portfolio to convert it, to take the money out and then convert it into equity. Why? Because maybe there is a transaction cost. There is potential tax liabilities. So you don't want to disrupt your existing portfolio. You can synthetically move from bonds to equity by entering into index forward contract. Or you can do it in a variety of ways. One of them is index forward contract. If you want to reduce the exposure to equity, you have an equity exposure already and you want to remove it. For example, you're concerned about equity markets going forward for the next 3 months. Well, you can sell the index contract. Again, as long as the index is highly correlated with your portfolio, it works. Otherwise, you have basis risk. You can buy put option on index to provide protection against downside. Again, there is a basis risk. Your portfolio and the index has to be very highly correlated. So again, mix and match. What designation types do you want to associate with the statements given to you in the right? For investors, they tend to transact more frequently in exchange traded derivative contracts. You don't have to worry about doing credit analysis of your counterparty. You don't need to spend time assessing whether the counterparty is credit worthy or not. You do exchange traded, so you're not concerned about counterparty risk. Now, what about issuers and investors? Well, they are both use derivatives to change their exposures to an underlying asset without transacting in the cash market. Corporate issuers use derivatives to hedge market-based underlying exposures incidental to their commercial operations and financing activities. So the idea is corporations are in a business to take business risk. Business risk is the risk of variability of revenues of their products. So that is their business risk. If they are manufacturing cars, the fluctuations in the demand and supply of those cars, that is a business risk they want to take. They don't want to take incidental risk of financing their operations or incidental risk of managing foreign currency exposures that is incidental to their business. So those are the risks they will try to hedge and keep their existing only business risk as their focus. So we will continue with the second part of derivatives, where we will get into a lot more depth. So this is basically only serving as a refresher of different types of derivatives, their uses, and just very brief introduction of different types that we already talked about. All right.